What is happening thousands of kilometers away in the Arabian Gulf is quietly shaping economic realities here in Nigeria. As tensions escalate around Iran and military activity intensifies in the region, one strategic choke point has come back into global focus: the Strait of Hormuz. Now let's understand why this narrow stretch of water matters so much. The Strait of Hormuz is one of the most important oil transit routes in the world. Roughly 1/5 of global oil supply passes through that corridor daily. Tankers carrying crude oil from major producers in the Gulf move through that passage to markets across Asia, Europe, and North America. So when the route is threatened or restricted, the global oil market reacts immediately. Traders anticipate supply disruptions, future market spike, insurance costs for tankers rise, shipping risks increase, and almost overnight, oil prices climb. This is exactly what we are witnessing. But what does this mean for Nigeria? On the surface, rising oil prices should be positive for an oil-producing country like Nigeria. Higher crude prices can translate into increased government revenue, improved foreign exchange inflows, and potentially stronger fiscal buffers. However, Nigeria's oil story is more complex. Yes, Nigeria produces crude oil, and yes, we have the massive Dangote Refinery, widely regarded as the largest single-train refinery in the world. Many Nigerians expected that with local refinery capacity at this scale, we will be shielded from global volatility. But the global oil system is deeply interconnected and dollar-driven. Crude oil is priced internationally in dollars, even when refined locally. The input costs are benchmarked against global prices. If crude prices surge due to geopolitical instability, the cost of feedstock rises across the board. In addition, the refinery's financing structure was built around dollar-denominated calculations. Construction contracts, foreign technical expertise, debt servicing obligations, and equipment procurement were largely tied to foreign currency exposure. This means that oil prices rise and the dollar strengthens. Operational costs and financial obligations remain sensitive to global market movements. While higher oil prices may increase Nigeria's export earnings, they can also put pressure on domestic fuel pricing, inflation, and exchange rate stability. There's another dimension. When oil prices surge globally, countries that are net importers of refined petroleum products face higher costs. Although Nigeria is improving refinery capacity, any gap between local production and domestic demand may still expose the country to international price swings. At the same time, higher global energy costs can trigger broader inflationary effects. Transportation costs increase, manufacturing input costs rise, food supply chains feel the pressure, and ultimately, consumers bear part of the burden. Nigeria could earn more from crude exports if prices remain elevated, yet the same price surge could intensify inflationary pressures at home, particularly in a fragile macroeconomic environment. This is the reality of modern geopolitics. A military escalation in the Gulf, a shipping route under threat, a spike in Brent crude prices, and within weeks, the ripple effects are visible in Nigeria's fiscal planning, fuel pricing conversations, and foreign exchange dynamics. The key questions now are strategic. Can Nigeria convert higher oil prices into sustainable economic gains? Will increased revenue strengthen, preserve, and stabilize the Naira? Or will global dollar pressures and domestic structural constraints limit the upside? What happens in the Strait of Hormuz does not stay in the Strait of Hormuz. It reaches Lagos, it reaches Abuja, and it reaches every Nigerian household. Our business homework, we are not just watching headlines, we're analyzing the economic chain reaction behind them. Because in today's global economy, energy security, currency stability, and geopolitics are tightly linked.